Pay less tax ethically. 7 proven strategies for Australians. Introduction. Most Australians overpay thousands of dollars in tax every single year, not because they are careless, but because they do not know how to structure their finances strategically. Whether you are a creator, a business owner, a freelancer, or simply someone with a salary and a side hustle, there are Australian Tax Office approved ethical strategies you can use to reduce your tax bill. This is not about loopholes. It is not about hiding money. It is about using the rules as they were designed, rules that reward you for saving for retirement, investing in your skills, running a business, and managing your money well. In this guide, I will walk you through 7 proven strategies you can start applying today. For each one, you will learn what it is, why it works, how to do it step by step, real-world examples, mistakes to avoid, and a quick action step you can take this week. By the end, you will have a clear plan to keep more of what you earn without ever stepping outside the law. Why ethical tax planning matters. There is a myth that if you are paying less tax, you must be doing something shady. That is simply not true. The Australian tax system is full of incentives, concessional super contributions, small business concessions, capital gains discounts, offsets, all designed to encourage certain behaviors. When you use these incentives, you are not cheating the system. You are following it. The difference between someone who overpays and someone who optimizes often comes down to knowing what is available, planning ahead, and keeping clean records. Think of it like this. If you walked past a $50 note on the ground and the owner said, "That is yours if you want it," would you leave it there? That is what ignoring legitimate tax strategies is like. Strategy 1. Maximize concessional super contributions. Concessional contributions are pre-tax contributions to your super fund. They can come from salary sacrifice through your employer or from personal contributions you claim as a tax deduction. These contributions are taxed at 15% inside super instead of your marginal tax rate, which could be as high as 47%. That is an immediate tax saving and a boost to your retirement savings. Step 1. Check your cap. For 2025, the concessional cap is $27,500 per year. Step 2. Review your year-to-date contributions. Log into your Super Fund portal or MyGov to see what has already been contributed. Step 3. Calculate your gap. Subtract your year-to-date from the cap to see how much room you have. Step 4. Decide on method salary sacrifice via payroll or make a lump sum personal contribution and lodge a notice of intent to claim form with your fund. Step 5. Time it right. Contributions must hit your super account before 30 June to count for that year. Example, you earn $120,000. Without salary sacrifice, you pay 37% tax on most of that. If you salary sacrifice $10,000, you avoid paying 37% on that amount. Inside super, it is taxed at 15%. That is a 22% saving, $2,200 in your pocket, plus the money is invested for your future. Advanced tip, if your super balance is under $500,000, you can carry forward and use concessional caps from the past 5 years. This is powerful in a high-income year. You can catch up and make a much larger deductible contribution. Mistakes to avoid. Forgetting to lodge the notice of intent form for personal contributions. Without it, you cannot claim the deduction. Exceeding the cap, contributions over the limit can be taxed at your marginal rate plus penalties. Action step. Log into your super account today, check your year-to-date concessional contributions, and set a reminder for May to review and top up if needed. Strategy 2. Choose the right business structure. Your business structure determines how your income is taxed, how much flexibility you have, and how well your assets are protected. The main options are sole trader up to 47% tax rate, best for simple side hustles with low admin company, 25% small business rate, best for reinvesting profits and scaling a brand. Family trust, taxed at beneficiary marginal rates, best for income splitting to lower tax family members. Self-managed super fund, 15% tax rate, 0% in pension phase, best for long-term investing and estate planning. If you are earning from YouTube, affiliate links, digital products, or advisory work, the right structure can cap your tax rate, allow income splitting, protect your personal assets, and make it easier to reinvest profits. Example, a creator earning $150,000 as a sole trader could pay over $40,000 in tax. As a company, profits retained in the business are taxed at 25%, freeing up cash for growth. Step 1. Map your income streams. Step 2. Identify your goals, reinvestment, flexibility, asset protection. Step 3. Compare structures with a tax advisor. Step 4. If changing, plan the transition date and open new bank accounts. Mistakes to avoid: setting up a complex structure too early, extra admin without extra benefit. Mixing personal and business expenses blurs deductibility and risks compliance. Action step: draw a one-page map of your income streams and note the best fit structure for each. Book a review with your accountant. Strategy 3. Income splitting with trusts. A discretionary family trust can distribute income to beneficiaries in lower tax brackets. If one family member earns less, allocating income to them can reduce the overall family tax bill. Example, your trust earns $100,000 from digital products. You distribute $30,000 to a spouse earning $20,000 a year. That $30,000 is taxed at 19% instead of your 37% bracket. Step 1. Set up the trust with a professional. Step 2. Open a dedicated trust bank account. Step 3. Invoice clients in the trust's name. Step 4. Keep detailed records of income and expenses. Step 5. Before 30 June, prepare a trustee resolution specifying distributions. Mistakes to avoid: not preparing the resolution on time can default all income to the highest taxed beneficiary. Distributing to minors: special tax rates apply. Action step: if you already have a trust, set a calendar reminder for early June to finalize distributions. Strategy 4. Prepay deductible expenses. Prepaying certain expenses before 30 June lets you claim them in the current year, reducing taxable income. Eligible expenses include income protection insurance, professional memberships, and business software and subscriptions. Example, prepaying $3,000 in deductible expenses in a high-income year could save you over $1,000 in tax if you are in the top bracket. Step 1. List upcoming 12-month expenses. Step 2. Decide which to prepay based on cash flow. Step 3. Pay before 30 June and keep the invoice. Mistakes to avoid: prepaying for things you will not use. Forgetting to separate personal and business expenses. Action step: in May, run through your expense list and mark prepayment opportunities. Strategy 5. Manage capital gains strategically. Holding assets for more than 12 months can qualify you for a 50% capital gains tax discount. You can also offset gains with losses by selling underperforming assets. Example, you make a $20,000 gain on shares and have a $5,000 loss on crypto. Selling the lost asset reduces your taxable gain to $15,000. Step 1. Review your portfolio in May. Step 2. Identify gains and losses. Step 3. Decide what to sell before 30 June. Mistakes to avoid: selling purely for tax reasons without considering investment goals. Forgetting to factor in transaction costs. Action step: add a portfolio review to your May calendar. Strategy 6. Super splitting to your spouse. You can transfer up to 85% of your concessional contributions to your spouse's super. This balances retirement savings, may reduce future tax on withdrawals, and can help with eligibility for certain benefits. Example, If one spouse has a much higher super balance, splitting can even things out and improve Centrelink entitlements later. Action step: download your fund's contribution splitting.